The Northstar Global Fund had a strong quarter despite challenging markets. 2022 has been characterized by the inflation trade as COVID supply chain bottlenecks persist and the onset of the Ukrainian war placed significant pressure on input costs. This is evident in the performance across different asset classes, equity sectors, as well as reflected in terms of geographical performance of stock markets and currencies. Countries rich in energy and materials have benefited significantly from surging commodity prices. Conversely, those countries that are dependent on import commodities and those reliant on Russian energies have underperformed, specifically Europe, where the MSCI Europe has been down 7.2% year to date. Specifically, equities and particularly long duration growth businesses have had a tough start to the year, as well as bonds who have suffered from higher and more persistent inflation, resulting in stronger and tighter monetary policies. Against this very tough equity and bond market backdrop, the Northstar Global Flexible Fund delivered resilient performance relative to the benchmark and peers. Year to date, the fund is down 2.2% versus the benchmark, which is down 5.4%, delivering just over 3% of gross alpha. And relative to peers, the fund remains in the top quartile. The global bond benchmark is down 6.2%, and the fund's significantly underweight bond position relative to the benchmark has helped shield returns. From an equity sector perspective, the fund is overweight healthcare, staples, and industrials versus the MSCI All Country World. Healthcare and staples outperformed while industrials lagged. The fund has zero exposure to energy and materials, which have delivered very strong returns year to date. The worst performing sectors have been consumer discretionary, information technology, and consumer communications, all down about 10%. Within the fund, if we look at the top four largest positive attributors, it has been Gold ETF, L3 Harris, British American Tobacco, and Berkshire Hathaway. Conversely, the top four largest negative attributors have been Disney, Unilever, Moody's Corporation, and Tencent. The fund's current equity exposure sits at 71%, with the balance of the fund positioned in gold, defensive fixed income, securities, and cash. With the discount to intrinsic value on our global buy list in the low teens levels, we do not see any meaningful adjustment upward in equity exposure at this point in time. The first quarter of 2022 has been a continuation of the fund's long-term track record, arising from sound asset allocation positioning and alpha generation at the security level, with the overarching goal of delivering equity-like returns with downside protection for our clients.